Hi, my name is Chris Konetsky. I'm the editor of the Des Moines Business Record. We're here today to talk a little bit about the commercial real estate industry. What we've done is gathered a group of business leaders here to talk about some of the challenges and opportunities as we head into 2014. So the format's a little bit like our Power Breakfast, if you've been to those before. And before those events, we actually bring the panelists in and have a discussion about challenges and opportunities. And that always have found is some of the best discussion that we have, and we want to give our audience an opportunity to kind of be a fly on the wall for that. And so that's why we've invited you in today. So thanks for joining us. And our panelists today we've got Chris Costa. He's the Senior Vice President at Nat Properties, Inc. We have Gene Nelson. He's the President of Nelson Appraisal Associates, Inc. in Urbandale. We have Richard Hurd. He's the founder and president of Hurd Real Estate Services, Inc. And lastly, we've got Tim Sharp. He's the Senior Vice President of CBR E. Hubble Commercial. So I'm going to turn it over to Ken Darr. Now he's our Real Estate and Development Beat Reporter, and he's been with us for 6 years in January. So go ahead and ask what.
I'll just start off by asking what the challenge is. What's been the big challenge in the industry locally in the last year?
During the last year, financing is always an issue with what we do. Nat Properties involved in a variety of real estate type businesses. We do residential development, multifamily, commercial, and the interest rate environment has just been excellent for us over the last year. And going into 2014, if that continues, that is really going to be a benefit to our business.
Kind of along with the financing thing, the appraisal industry has been very active, and the prior challenges has been, just having transactions to sales to deal with, usually as comparables. That's we rely on that greatly, and then more recently there has been some sales of properties. Some of them, if they've come out of foreclosure or something like that, tend to be a little bit lower than some of the. Now we're getting more market-related transactions. And, that's been good for us, actually.
Richard?
I would say that for what we do, mainly the biggest challenge has just been the economy as in general. So we do a lot of build-to-suit work for national companies, and so we need those companies to be expanding again, and they are beginning to do that. We are building some new stores. We had seen, as most people that in our industry had seen during the past 4 or 5 years, a big slowdown in that activity that's starting to come back. So really the overall economy and the expansion of business is really the big issue for us, along with, and I would agree, that availability of capital, but that's turning the corner as well.
I'm going to give tonight around the product cabinet group for CBRE, which is the largest vertically integrated real estate firm in the world. And we're focused particularly on investment real estate. And our challenge is finding there's a supply-demand equation, particularly in the multifamily sector, that is greater demand than there is supply. So one of the biggest challenges we have is to find enough product to satisfy that demand. We've got people from all over the country coming into this market because of its uniqueness and the yield potential versus comparable product in other markets. So we're always on the lookout for properties that we can market to a huge demand base that we've got coming in here.
Are you seeing a change? And you had mentioned to me some time ago that some folks had expressed interest, I think, in the Riverfront Wine building from investors from Israel. I mean, you said that we're no longer flyover country, I think was the.
Yeah, I think Des Moines is starting to get a reputation for it's got great fundamentals. Number one, low unemployment. You've got a great demographic profile in the city. The YMCA property is the gem. It's a highly sought after property that the city is keenly involved in. We have had inquiries from a number of different sources. On that particular property, there's been no international But we do have, as a matter of fact, next week we have a group coming in from Athens, Greece, and Dubai. And we've got a couple Canadian groups in there, all of which are looking for multifamily in this case. But
That's really the hot.
yeah, that is the hot button
Yeah.
right now.
Regarding the economy, I mean, is everyone still waiting for a big bust out of decent paying job? I mean, I would think on the retail side in particular that would drive more interest among retailers. Right or wrong, Richard?
Well, retailers are, focused on demographics in a big way, and that's never been more acute than since the recession. So, from their perspective, I mean, they look at those numbers and they can make decisions based upon their stores on demographic numbers, which includes employment and employment levels as far as wages and percentages. And I mean, I think it's a big issue, but Des Moines is really becoming known as a very stable market, very predictable, did not experience the highs and lows that a lot of the other markets experienced, and therefore is gaining a national reputation as being a very good place to be from my retailer's perspective because of that.
Yeah, we see the same thing. I mean, Des Moines doesn't have, like Phoenix, Arizona, for instance, it doesn't have the rapid ramp up and ups and downs. To that end, Des Moines is kind of boring, but since the recession, to most people, boring is pretty good. Just the stability is a key.
Someone you're pretty familiar with, let's find a saying, we don't hit home runs, we hit a lot of singles.
But expanding on your guys' comments about stability, we went through the recession and all of us were impacted in different ways, but you read the national news and real estate was affected by 10, 20, 30, 40% in some markets. When we go through an exercise at the end of every year, we value every asset that we own, every real estate asset. And we really, in some of those years, had an expectation that we were going to see some dramatic decreases in the value of our real estate. But we don't get crazy when times are good and start valuing a commercial property at a 5.5% cap rate. So unless cap rates in Des Moines really went crazy, our values from year to year stayed relatively constant. We're more affected by vacancy than any other factor. So that's where I think we see investors from outside our market looking at 8 or 9% returns and say, holy cow, I can't get 8 or 9% return in my market. So come someplace where it's a little more stable.
Well, that plays into the valuation too. These guys especially are out around the country seeing lots of transactions with a lot lower cap rates than we have here, and it just doesn't catch up, which kind of is good in a way when things turn back down.
Right.
But it does kind of keep us somewhat centered into the kind of middling valuation.
On the multifamily sector, over the last 12 months, we've seen a little bit of cap rate compression. And that's not necessarily true in other asset classes, but particularly in multifamily because of the supply-demand equation. And I don't know how long that's going to last. Every market cycles. If we're just kind of getting to the peak of the multifamily market, we're seeing a lot of new construction going on now. So that supply-demand equation is going to change. That'll affect cap rates. But by and large, we're seeing out-of-state and out-of-country investors coming to this market, and because of the stability of it and the returns that they can get versus their home base.
Are they interested in new construction, or they're probably looking for existing?
You've got tiers of investors with a lot of it depends on where their equity's coming from, where their money's coming from. REITs are different than private investors, and so you've got the REIT sector is probably looking for A and B properties pretty much stabilized. You have some value add players out there that will take older properties that maybe have a management upside or income upside. And so they're kind of all over the board.
Are we anywhere near to overbuilding multifamily?
I think,
reaching the saturation point. Yeah.
well, you know, obviously, we're increasing it, but the demand has increased.
Mhm.
The people that are involved in multifamily, like the millennials, for instance, don't seem to be quite as interested in homeownership. Is not as quite as important to them as it was to us when we were growing up. So you see a demographic shift going on there that feeds into that. And on top of that, you have great job creation, good fundamentals with the financial services sector. And that creates job opportunities. People coming into this market may be here for principal or ING, or somebody might have somebody coming in for a year or two. So instead of buying a house, they'd rather rent. And then there's the downtown submarket, the CBD submarket. You can't hardly find a place to rent down here. So yeah, I think that the demand is going to stay pretty constant for the near term. Obviously, at some point in time, there'll be a point in time where the demand will decrease and supply will level out.
How much of what happens downtown triggers what happens, in the western suburbs or anywhere in Greater Des Moines? Does it feed off of that, or West Des Moines seems to be able to generate its own amount of energy out there?
From a value standpoint, I think they act pretty independently of each other.
Mm-hmm.
If you want to be downtown, you're going to be downtown. If you want to be out in the suburbs and don't want to travel back and forth, or for whatever reason, some companies, the large insurance companies, there are certain ones that like to be downtown because it's all the bus lines and all their employees that work in the background. People rely on those bus lines and want to be here for sure. And then, on the suburbs, they rely more on just, car traffic.
I'll steal a thought from Bill Knapp, who's, his impression has always been, if you have a strong downtown, you have a strong economy in most of the suburbs. And so he's always felt it necessary to try to maintain downtown as a focal point of the community, and it should benefit the rest of us that are in the suburbs. Absolutely.
I guess we're kind of seeing that demonstrated right now.
Yeah, well, yes, yeah, exactly.
A lot of money being spent now.
Yeah.
And of course, the CBD is getting different metrics in the western suburbs. This is CBD is a place where you walk most places you go. You have an office here, so you can walk. Out in the suburbs, first thing you do is you get in your car and you drive someplace. So, walking, running into people down on the skywalk system is kind of an interesting dynamic. When I was working downtown, you don't see quite as much of that out in the suburbs.
True.
What about competition for tenants? Is that what's happening with lease rates?
We'll tackle that for Trigger.
Well, what we do is very locationally driven. So if we have the right product, we probably don't have a lot of competition. It's that simple, because a lot of what we do is retail. And retail is very location sensitive. If you're doing office, it really doesn't matter if you're a block one way or another, but what we do, it's important what corner you're on and what side of the street you're on, and your access, and those types of things. It's just very different. So it's, competition is what it's always been, and really, if you control the right real estate, you're probably going to win. If you don't control the right real estate, you won't. It's that simple.
And I guess from an office standpoint, a lot of what we do is in the western suburbs, and we have very low vacancy. We've got some pretty good locations that we've had pretty good luck keeping leased. If you look over the last 5 years, 2009, 2010 were real challenges for us. There just wasn't a lot of movement of companies in the market. Nothing new per se has come out of the ground on a speculative basis, so there hasn't been a lot of new office space added to the west suburbs. So over time, we've gotten to the point where we're about 5% vacancy in our whole portfolio. Most of that's downtown currently, and that's still a challenging market for us, and competition for downtown tenants is very stiff, and the returns are not great currently.
Do you see yourself doing any more speculative office development?
And we look at different opportunities, and it's very difficult to bring something out of the ground and expect to get a rental rate to justify a return on their investment still. And so without any increases in rent, and one of the corridors we're very strong in is just that Westtown Parkway corridor. And rents along that corridor have been $10 to $12 a foot for years, as Gene could probably attest to, for second generation space. Now there was some new properties put up in 2005, 2006 range, and they demanded $15, $16 a foot net rents, and that was easily obtainable for a first generation space. But second generation, they're right down with the rest of us. They're fighting for the tenants at 10 to 12 bucks a foot. So.
It's been tough to drag rents for a long time in the office sector.
Yeah.
You know,
Well, the thing that drives office and office demand is jobs and companies expanding, because a lot of our companies tend to expand if things are going well, but they're just been kind of waffling back and forth of late. So the demand has not been there, so there's no pressure to push up those rates, and the vacancy may be pretty decent, but the rates just haven't pushed up, and then you just can't afford to build, pay for land, and come out of the ground with with the bricks and sticks without justification. And you're right, the answer's been $10 since the late 1980s. Really for most of that net lease product out in the suburbs.
So getting back to the employment, I think, there's been a lot of resistance of our employers to expand because of the uncertainty out in the marketplace. There's a lot of uncertainty about interest rates, what the government's going to do, what the impact of Obamacare is. And so I think that dampens the employment metric and puts kind of a hold on things, because nobody knows what's going to go on. I mean, if the government can smoothly exit the quantitative easing, you're going to see interest rates gradually rise. However, that gets mitigated by the fact that the economy, there is going to be on the rise also. But if the QE gets, if they do it too quick, then there'll be this slingshot effect on interest rates. And quite frankly, if they do it too fast, I think there's a possibility that we go back into a recession because of the interest rate.
What about what do you anticipate the impact being of the commercial property tax reform? After it happened, I had the impression a lot of people in the commercial real estate field were just sort of shrugging their shoulders a little bit.
My personal impression is, from a property tax reform stance, multifamily just had a tremendous benefit with their potential rollback down to residential tax rates, which anybody who's owned multifamily knows that property tax is a significant portion of the expenses related to operating that project. And getting that number down to 60% or 50% of what it is today is going to be a tremendous boon for apartment owners.
Yep.
From a commercial building standpoint, I think they're talking about a credit of maybe $3,000 per building.
Mm-hmm.
Now, it's not for nothing, and typically our buildings are triple net leased properties, so the tenants are going to be the ones benefiting from that, but it's not amounting to the kind of number necessary to demand any kind of resurgence in
Yeah, I agree with you.
development.
On the multifamily side, it's when we have out-of-state investors come in and they look at our taxes, they can't believe it. They question who's really this high, and so yeah, so is your competition. So it's been a positive thing for multifamily, no question about it.
We've done a little bit of study on multifamily, because that's all basically a gross lease, because the landlord pays all the taxes, of course. So what we've done is a little spreadsheet that shows the impact of the gradual reduction in the rollback. And to make a long story short, over an 8 or 9 year cash flow, that comes back to about 11-12% increase in overall value. And so we've been starting to make adjustments on sales that were occurred before the rollback law, the tax law change, and we're starting to make adjustments to the properties that we're valuing now because of that. And I think it's a real situation. Are you thinking that way?
Oh, yeah, we would have loved to have owned more apartments right now when
Sure.
they passed the property tax reform, because realizing that you're capping the bottom line at some point when you come to a value of that property, the significance of the taxes is just
Right.
overwhelming.
It won't affect the ones that are already, condominium regime or co-op approved already. It has no effect on those, but the existing properties that now don't have to go through that process or couldn't go through that process because they're in a city that wouldn't really effectively allow them to, then those properties will be the beneficiary, and we're reflecting that in our reports.
I was going to ask, I was talking to a commercial lender yesterday, or a banker, who said, we were talking about a piece of property they had, and he was saying that offers, especially on bank-owned property, have gone from silly and insulting to, even if it's a deal they're not going to take, at least they have to sit down and at the table now. I know value is relatively difficult to get your hands around, I suppose, but what are we seeing now? Are values coming back to a decent level?
Well, I believe they are. Certainly the values, I think, did go down, because there was a lack of demand. And the companies that were in some of the buildings, if they went bankrupt or out of business, or the tenants' rent roll went down, they had no choice but to go down. But now that these projects are getting occupied and at a healthy rate, you're saying 5% vacancy, and retail I think is 10 around. Those values just have to come up. Also, with interest rates going down overall over the last 3 or 4 years, that allows that cap rate to kind of compress a little bit. That pushes up the value because of the inverse relationship between cap rates and value. So
That could change rapidly depending on what they do.
and that can change rapidly. I see that the mortgage rates for homes are now 4.46 on average, and I bought a house in April, and it was I think we were at 3 point something, and so that really makes a difference. And again, what effect that has on occupancy for apartments, for instance, maybe it stays in demand because people aren't going to for sure buy houses now.
That's a dynamic that currently is hard for me to explain. We've never developed as many residential lots as we have in 2012, 2013. And not just developing to develop. We are selling at a pace that's unprecedented in my 16 years at NAP Properties. As I look back at some of our numbers, in 2009, we sold exactly 1 residential lot. For 4 years, 2008, 9, 10, 11, we developed 0 residential. There was just absolutely no demand. And as we talk about some of the bank-owned properties that went back to them, and they were trying to get rid of that inventory, their prices were very low, to the point of we couldn't compete by developing new ground with the existing bank-owned land that they were trying or the residential lots they were trying to sell. Well, 2012, 2013, we've developed approximately, and we're not huge developers, but about 70 lots in Waukee, 40 lots in Polk City, and we're 70% sold or sale pending or optioned of those lots. It's just the inventory has gone real quickly. We got a project in Urbandale off of Hickman Road that won't be completed until summer of 2014, and we're taking reservations for lots, and we're about 70% reserved there. So the dynamic is interesting to me. I know apartment occupancy is just unbelievably good right now, but so is residential land and lot development unbelievably good.
You're
So-
actually kind of, the market's outpacing your expectation in Waukee at least. I think I would.
Yeah, and we've sat on this land in Waukee, and we waited for development to come our way. And Waukee has an excellent school system, so that's always a factor when people buy housing. And we knew eventually this land was going to be of value for residential development. We didn't know that once we started development, we would have this kind of success. Now, again, I can attribute it to where we're at with mortgage rates, and that's got to be part of the issue and the benefit for us currently, and they've ticked up about 1% in the last year, so that's worrisome for anybody that develops residential land. But we've sought out the right opportunities, and Urbandale and Waukee are very strong. And Polk City has always been a strong area for us, and that's a growing community as well.
Are there sort of development corridors in the area that are flying under the radar that are going to boom for whatever reason? I mean, are there sleeper areas?
It's quiet.
Yeah. I mean, everyone anticipates Waukee, West Des Moines, Urbandale, a little bit. East, northeast, anything just out there?
Well, we know we own some land where we like to
Yeah.
fly under the radar. But I think, from our perspective, again, the western suburbs, we're focused on the Dallas's Road corridor, 2014, 2015.
Yeah.
I know Mr. Hurd has some stuff out there as well. We just think that's going to be an excellent opportunity. It's certainly not flying under the radar, and it's been getting press for so many years now that it's about finally ready to happen. But southwest part of Des Moines, we would appreciate to have some development activity. We actually own several tens of acres of land. We call it Airport Commerce Park South. It's out near the Highway 5 bypass. And we thought when Highway 5 went in and they redirected Army Post that would be just a real flourishing area. And it hasn't been. But that's not to say we aren't close to something happening out there. We're looking at doing some warehouse projects out there. If we do see demand for warehouse and industrial, and we hope by putting up maybe some spec, we might do some spec. We're looking at the opportunities now, but we hope we can kind of start some development out there.
You look in larger cities and around the airport, that's all you see. And it's not the case here anymore. And I've always wondered why. I really don't have an answer for that.
Excellent access out there, the Highway 5.
Will the possible interstate designation, which I understand one of the big hangups for that is you won't build dry farm machines. I mean, would that do anything?
We feel it would.
Mhm.
We feel that national tenants are much more interested in locating their interstates than they are highways. And we feel it can't hurt, obviously, but what kind of benefit?
Plus you get federal money in. I mean, I'm assuming there's a spillover effect of having federal money come in and build out interchanges.
Yeah, part enough.
I'm wondering, you said you weren't quite sure what the reason was for the development. Does anybody have any hypotheses on why that area hasn't necessarily? No.
Natural play, like UPS has expanded their facility there, but it's just not like other cities of comparable or larger sizes where that's all you see in that area is right around the airports is the warehouse component.
We do have other surrounding areas, because we're at the confluence of Interstates 35 and 80. And places like Urbandale, Grimes, Ankeny, they're a lot more level than around the airport too. There's a lot of topography challenges around the airport. So if you're going to put a big warehouse there, when they did expand that, the warehouse building down right next to the airport there, south along the north side of the bypass, they had to do a lot of fill and pushing dirt around to put a big a floor plate together to put that. But there's some topography challenges down there. That's like about a possibility for the challenge. The reason they're not a bunch of warehouses down there.
You know, given that we are kind of a hub there, why hasn't there been more warehouse development? I mean, there's not a whole heck of a lot of industrial space, warehouse in the city. What accounts for that?
It's hard to explain. You know, we aren't experts in that field, but as we look at the possibility of doing some projects out there near the airport, what we understand is it's been stronger in the suburbs because of the access to 80 and 35. The access to 80 is seemingly more important than 35 because of where the population goes once it leaves this community. So if they go west or east on 80, they go to Chicago, Milwaukee. Whereas if you go north off 35, it sounds like Minneapolis is really your only big destination. So that does make some sense to me as to why you might want to be closer to 80. And we're looking at it from the standpoint that we hope that the market moves a little bit south. But
I'm going to assume that if you're talking about possibly building some spec warehouse, and I think a lot of people were surprised when you brought Dick's to town, and people are not that was a spec project, but people are starting to talk more about speculative projects in general. Which the obvious question is, I'm assuming that means that the economy really is bouncing back, and the markets are, at least in your opinion, looking pretty good going forward.
And I don't want to mislead it, but we're not big speculative builders.
Right.
And if we see the right opportunity, and typically we try to pre-lease at least a portion of it before we bring anything out of the ground. So we'll kind of wait and see what kind of interest there is before. I mean, if we had great interest and no tenants, we might bring a speculative property out of the ground. But we're looking at doing retail in different areas of Des Moines. And typically, we aren't speccing any of that. It's based on conversations with potential users and have a pretty good idea of whether we're going to be able to tie down that user before we move forward with the project. So, you know, we're not really speculating anywhere other than this possibility with warehouse.
Yeah, no, I didn't want to overstate that,
Yeah.
that either. But how about you, Richard? I mean, you bought some property at what you call described as a main location there at 31st and Ingersoll. I don't think you have a tenant ready to go in there yet, but you haven't done a lot of spec projects in several years, have you?
No, it's all driven by the economy, demand, availability, competition. And you know, we have throughout the recession, I mean, we bought a lot of properties from three classes. One was lenders, two were real estate investment trusts, and the third were primarily corporations that were selling facilities that they no longer had need for. And throughout the past 4 or 5 years, you know, we bought somewhere probably between 35 and 40 properties from those types of sellers. And as a result, some were were turnaround projects, like the Ford dealership building on 8th Street in West Des Moines. Some were functioning properties that we've nurtured. Some were great properties that we had sellers that just needed to divest themselves of a certain level of property. So it really boils down to what is happening at any given time with the market, with the our particular workload, how much we have on our plate, and since we're in 9 markets, it also has to do with what's going on in the other markets that we function in. So I mean, I can't really tell you that we were doing that strictly for spec. We were doing that because we felt like it was an area that would make sense for us to do it. It's a small project. It's not.
No, I understand it. So what is happening in your other 8 markets?
We have projects that are underway in Indianapolis that market has rebounded nicely. We're in Chicago. That market held up quite well during the recession. St. Louis, Kansas City, pretty much the same. We're in Omaha. Omaha mirrors Des Moines quite closely as far as what happens over there. The economy, really kind of runs in parallel. The southwestern division that we have is the one that's seen the most turbulence. But we've probably made some of our best buys in Phoenix and in Las Vegas, quite frankly, because those markets were redlined by a lot of investors. And so in 2009, 10, and 11, there really wasn't a lot of competition for properties in those markets.
Retail properties primarily? Or?
Most of them, yeah, those two markets, what we purchased were retail.
Mhm.
Another interesting component though, Ken, is if you look at what's happened in terms of values though, it's really not locationally driven on a lot of the properties that we own or development that are really considered commodities. And those would be Walgreens or Wells Fargo or Quick Trip, the big credits that are totally net leased. And interestingly enough, the value of those properties have increased in the last 4 or 5 years because of cap rate compression. And even though interest rates have maybe on the move a little bit in the last 6 to 9 months, the cap rates are continuing to compress because there's so much demand for yield. And Tim mentions apartments, but I have to tell you, net lease properties are, we have people contacting us, multiple brokers and investors, and even the big real estate investment trusts contact us all the time about buying product. Net lease properties are probably the lowest cap rates I've seen since I've been in the business. And it's not all the big cities, or it's not all California. I mean, we have transactions going right now where we're selling things in the 5 cap range rate. And those are not in Des Moines, but they're in bigger cities. But the point is, even in Des Moines, I mean, we have one transaction right now that's at a 6. And that's, those are strong rates for Des Moines, Iowa, and even in the Midwest. So the reality is there is an awful lot of capital chasing quality product. If it doesn't meet a certain standard, it's very difficult to sell. But if you have the right product, I mean, multifamily is right up there, and quality net lease, there is not enough product to go around.
We're seeing kind of an increase in demand in senior housing. I think that's somewhat prompted by what's going on with the Affordable Care Act and the demographic.
Just getting older.
Just getting old. There's 65 million of us baby boomers out there, and we're not getting any younger. So I mean, that's a sector that you're going to see a lot more activity in.
I guess, I mean, I'm going to assume you're all pretty bullish on the future. But where are we going to see the most activity again? You may have just answered that question.
Well, as Richard was saying, we've got liquidity back into the market now, and there is a lot of capital laid out in real estate. I mean, it's got a lot of potential, and it's not going to be just a blip. It's going to have long-term implications. Different asset classes, like I say, they have their cycles. And multifamily, 2 years, 3 years down the road, might be a little bit different position. Retail's coming on the rise. Office is not doing much, at least in this market. And there has been a considerable uptick in the demand for industrial. I don't know how Realty developed where 120,000 square feet of high-cube warehouse in Grimes and sat on it for quite a while. It's full now. And they're going to do another phase. But in this market, my understanding, I don't do a lot of industrial, but it's kind of hard to come back. In large denominations.
So is Greater Des Moines Are we nearing the point where we get IKEA's attention? And there's some magic to having an IKEA come to town? That isn't purely population driven?
I don't know, Rich, what do you think?
There's some prestige to that, I think, in terms of just the fact that IKEA locates in your community, but we're quite a ways away from that. I mean, they're just now building in Kansas City, so I look at the difference in demographics. Kansas City is just now getting an IKEA. We have a ways to go here.
As long as the IKEA in Minneapolis keeps seeing Iowa license plates, I think they're going to be just happy to stay there and not venture into our market, perhaps.
You mentioned, we talked a little bit earlier about office vacancy. And how much is that, and you talked about uncertainty, and what would it take for the office vacancy to go down a little bit here? And I guess downtown, I think, is...
Well, it's all about employment. And if employers aren't hiring, they don't need the space. We've come out of a real rough period, unprecedented in our lifetimes. So probably it'll take a little bit longer than your normal average run-of-the-mill recession to get recovery. But again, with all the major factors that's at play out there, the uncertainty factor is putting a drag on the employment segment. And so, timeframes, how long it's going to take is going to be a function of some of these things coming down. If the government does the quantitative easing, does it right, fundamentals will start to improve, because that's why they tapered off their monthly buying of bonds. So that's ideally going to be a slow transition. At that point, you'll see vacancy go down, and employment go up.
Do the things happening, the housing and stuff happening in downtown, does that have an impact on businesses making decisions on whether to locate in the downtown core or locate out in the suburbs?
I think it happens the other way around. There's businesses downtown, insurers that are downtown, that will stay downtown no matter what, because of lots of reasons. So that drives the housing a little bit. The vacancies in the downtown buildings have gone down, but it's because they're being backfilled with residential developments and mostly rentals in the form of rental properties. So the demand for rentals is everywhere, including downtown. So that's driving these buildings to be occupied differently, and then that takes up product, which then starts to compress our vacancy rates. And now they're in that 17 to 19% vacancy, whereas before it was 25 to 30% vacancy, and it's all been, quite a bit of it's been because they've been now backfilled with residential.
Historically, what is the office vacancy rate been, if you're going further back than during the recession?
Back 25 years ago or 28 years ago when I started appraising, it worked downtown for 22 years, and we did a survey every single year. And it always kind of fluctuated in the 10 to 17%, just always right, floating back and forth a little bit. Hardly ever changed much until, probably in the mid 2000s, 2005, 6, and there was so much construction out west that even some of the companies started moving out west, and then other companies started recommitting downtown. That kind of stopped that bleeding a little bit. Then the poor economy hit, and then the vacancy ballooned.
It seems something like the principal expansion and staying here, I guess, that's got to be something of a signal anyways.
Well, there's principals, but ING, they recommitted. They put the buildings a few years back, and Wellmark, of course. So all these companies that are recommitting to downtown will kind of drive, I think in this case, housing, occupying these buildings.
I guess that makes me wonder too, whether are there more candidates downtown for conversion from office space to residential.
I think the pickings are getting pretty slim.
Yeah, I can't imagine the rural end tower, for example.
Your C buildings, Class C buildings,
Yeah.
that are, because of floor plate size, are basically functionally obsolescent, obsolete. they're the candidates, and most of those that I'm aware of are pretty much in the hands of developers at this point.
And what's the occupancy like at the Midland building? It just sold, it's gonna stay commercial, I think.
Yeah, I'm not sure of their intentions. I know those folks a little bit, but I have not talked to them
Mhm.
about what their
Mhm.
plans are.
Great, I'll tell you, I'm just about out of questions.
Okay. Well, we have just a few minutes left. Do you guys have any questions for each other at all? Before I turn it over to Ken to ask you. Ken, did you get a chance to ask the one question that you wanted to get?
I think so.
And then what we'll do is just wrap it up with kind of a final takeaway if you want. So, do you guys have any other questions you'd like to ask each other?
I think kind of revisiting Chris's point on the lot inventory. We do a study every year on. We used to transact about 4,000 to 4,500 lots every year, and that number went down over time. But there's still a few lots being sold, so no one was building any because they couldn't get financing for anything. Well, that inventory got down to about 1,000 lots. So now that's what's caused that backup, pent-up demand. And so then that drove all the new streets and all the new lots that have been put out there. So it seems like it's a dramatic increase, but really in effect we're just getting back to a normal 3,500 lot per year type of transaction frequency.
Are we gonna see any more 200-acre residential developments?
The thing is, they won't be able to get financing
Mhm.
for that much at a time. Then in Chicago, you go by these neighborhoods, they develop a whole, section at a time, and all the houses, there's 4 house choices, and that's not really our market. It's not. We're going to develop 40s at a time.
That's what got some of the developers in trouble.
I was gonna say, was it ever a market?
I don't think it was. And we just tried some. We just know that you get too big too fast. Sometimes it just gets. You take too big of a bite, and then that's where we get in trouble here in the Midwest.
That was interesting. We were talking about the millennial generation and buying homes, and we were on BC on the partnership trip, and they had a speaker talking a little bit about that, and he said that a lot of people in that age range, the 25 to 30ish range, where they aspired to own a home still. So they've done surveys, and there's still an aspiration to own a home someday. But if you ask them about do they want to buy a home, it was very much I'm not going to stay in an apartment right now. So it was kind of an interesting dynamic. I live downtown, and my wife and I live here. And the idea of buying a home sounds. I graduated in 2009, so you graduated during that time, and
Yeah.
you can see what that does. And my friends and I, when we talk about owning a home, it sounds dramatically risky in comparison to
Yeah,
I could stay in my apartment, and that might not actually be the real case, but.
With the employment situation the way it is, people like yourself coming out of college not knowing exactly
Mhm.
what the employment outlook's going to be, might want to stay footloose and fancy free. Get that first job and be ready to move to the next city or state, at a moment's notice, and not have to worry about selling a house. So I think there's a little bit of that going on.
And I think you look at where the stock market is currently, and you get back to when Greenspan said irrational exuberance. I mean, who thought we'd see the Dow at 16,000? And for us that just came out of the Depression, I think everybody's wondering when the other shoe is going to drop. You made the point about uncertain times, and I think for those of us that have been around for a while, you make hay while the sun's shining. And 2013 was a real nice year for our operation. If things stay similar in the economy in 2014, I think we'll have another nice year. It's the global impact that will affect the local economy at some point. And what I'm talking about is market, stock market, interest rates, national debt. I mean, all those things are going to tie into what the optimism is of the younger generation going forward.
Do you think you mentioned the shoe dropping, is when people learned from the last time and are better protected in case the
Well,
situation?
I think the one thing a lot of people learned, if they didn't know it already, was cash is king. And if you had to refinance something during the recession and you had Gene valuing your property and the value was down 30% and you couldn't borrow, you couldn't refinance the number you already had on the property, then you better have had some cash in the vault to draw on to retain that property. In Knapp properties, Bill Knapp was always, I shouldn't say always, I think he went through some times in the late 70s, early 80s where he was really worried about keeping the doors open. And ever since then, we've been very focused on what our cash position is. So if there's anything people have hopefully learned after having gone through this recession is you need to have cash available in times of need.
I think the reason that many of the companies failed during the past recession is not because they weren't good companies necessarily. They just didn't have enough cash available to weather the storm.
Well, I think that'll do it for us, unless you guys have anything else.
Appreciate it. Thank
Appreciate
you.
the help.
Appreciate it.
Well, Kent and I will both have our contact information up on the screen there, and if this spurred a story idea or you want to reach out to either of us, we're always willing to grab coffee and learn a little bit more. And so I just want to thank you guys all again for your time.
Thank you.
Thank you.
Thank you.